Now, as the European Central Bank lowers interest rates for the second time in a span of 3 months, all eyes are on the US Fed, which is widely expected to announce a rate cut later this month. And by the looks of it, a US rate cut seems inevitable. We've discussed this. But if the recent data is anything to go by, the CPI data that came in the US, it came in only yesterday, shows that inflation in America is well under control. Their jobless claims, though, have seen a rise for the first time in 3 weeks. But the producer price index, the PPI, that measures the average change over time in the selling prices received by domestic producers for their output, now that has come in higher than what was previously estimated. So the question, of course, is not when the Fed is going to start cutting interest rates, but by how much. And the much anticipated rate cut by the Powell-led Fed and its cascading effect on global markets and economy. Now that's our big story that we are tracking on India Tonight. To discuss this, Anurag Singh, managing partner at Ansid Capital, is joining us from Chicago. Welcome to the show, to India Tonight. Anurag, after the Trump-Harris debate, I was wondering how Wall Street is going to react. We've seen it end up pretty mixed, but now what is capturing the mood of the markets? Is it fairly and squarely lying on the Fed's next move on interest rates? And if so, have expectations of a 50 basis point rate cut gone completely out of the window after the last core inflation numbers have come through?
Yeah, Vikram, good evening. So 50 basis point anyways was a market fantasy. I think that was not going to materialize. I think we've discussed this equation, but I always kind of start with this point that, look, between the 5.5 to the end state of 3.5 by 2026, there are about 8 rate cuts to go. And there is about like almost a 2-year time frame, for the Federal Reserve to achieve that. So any point expecting a 50 basis point, unless there is a crisis, is kind of wishful thinking, Vikram. So I think I was not expecting market can make its conjectures. But yeah, of course, I mean, that's a reality check. It's out of the window. Also, I think you were quoting some of the other data, Vikram. I think even look at that. For example, jobless claims. Now, we can argue about it's 230K, 215K, 210K. But it's not recession. Recession jobless claims are 350K, 400K. That's the kind of numbers that's in a recessionary economy. These are normal numbers. So all these numbers, even the jobless claims for 6 months, 1 year down the line, even the current jobless claims, vacancies to jobs ratio, all of that points to the direction that we are normalizing, and we have nearly normalized. So all of these numbers are very akin to what they were in 2019, Vikram.
Yeah.
So yes, 25 basis points, start of the rate cut cycle, that's good news.
Right. Yes, of course. Complain. And then the kind of pace that the Fed follows. But typically when the Fed cuts interest rates, Anurag, the US dollar takes a beating. But now that most central banks are going in for that kind of rate cut cycle, does that limit the decline that we could see in the US dollar? And if so, what's the expectation on capital flows into Indian assets now?
Yeah, of course. So look, I think so the dollar index and plus, other 6 currencies, how do they interact and behave? Much depends on relatively how other central banks are doing. Because this time it was a global inflation and then the global rate hike, and then the ECB has already cut 50 basis point. I doubt dollar index will fall below 100 much because relative basis it is still doing well, right? And US economy is still the most robust, so US central bank has the best position to start the rate cut cycle vis-a-vis other economies, especially European Union, right? So that limits the extent to which dollar can fall, right? But all said and done, we've interacted, when dollar was 107, 108, even those days, imagine, now it's closer to 100, 101, 102, that's a much better number. And with the, resurgence of emerging markets, people say the worst is behind us. It has good news for all emerging markets. Basically it's connected to the 10-year yield. So as much as the 10-year yield drops, it drops from, so it's now currently about 3.6, 3.7, 3.8. That's the number. Suppose it broadly stays between 3.5 to 4%. I think that's a reasonable, it's not it's not zero. Well, so it's not 1.5. It's still 3.5, and that's why you see a moderation in the flows to emerging markets. The money is coming, but I mean, compare 4 years back, it was like 1% or below. That kind of flow is not happening.
Right.
And so I think we'll have to wait for that, Vikram.
So if we've seen a resilience in the American economy, and that's basically bodes well for emerging markets as well, do you expect the RBI's monetary policy to align with, or do you think they're going to diverge from the Fed's rate decisions in the coming quarters? And based on the RBI's moves, what kind of impact do you see on liquidity in the Indian markets?
Yeah, so one of the biggest puzzles, Vikram, for the world right now is Indian markets. I mean, I can totally appreciate the kind of euphoria around the economy and the biggest, largest growth economy. By the way, we've all been there, and in the past, and we have seen that it's not anything new. At our size of per capita income, we should be the largest growing economy for so many years together, right? So that's no surprise. Liquidity in the Indian markets continues to surprise, but I mean, the prices are not right. Maybe we'll take a time correction. That's okay. I mean, let people realize that markets don't provide 15 to 20% returns per year. It doesn't happen too many years in a row. So that's that. And I guess there's nothing to panic. Markets will take care of, this greed and fear balance. I think somewhere, it'll get balanced on its own. On the RBI, it's a tough case, but I think as long as Federal Reserve and other central banks have started to cut, RBI has a room to cut. But here's the story. Where is it ultimately going to end? So from a 10-year yield perspective, from a 7%, you can get to 6%, maybe a 5.5 to 5.75. I don't think it goes below that, right? That'll be a very different regime for India.
Yes.
So, I mean, there's 100 basis points to go. I mean, we can take it in a year or 2 years. That's okay. In any case, in India, investments are not related to 10-year yields, right? So, rate cuts can wait as well. That's my view, Vikram.
Right. So, if they get delayed with the kind of food prices that we are seeing, and that's definitely having a telling effect on our own CPI. It's all right, you're saying, but look at what's happening in Europe. The ECB, the European Central Bank, has cut rates today. What does that say about the future of global trade with Europe? How is their slowdown going to affect countries like the US and India, you think?
I just wanted to leave with one small comment, and I think I'm a very small voice in the whole system, and I think there are pretty wise people there, looking at this. Indian CPI index, Vikram, needs an overhaul. 50% of that is connected to food inflation. A person lives his life, 50% of it might go to food, but that's, talk of the median consumer, it might be the case, but usually, it doesn't have the right weightages to home and other automobile and other lifestyle, education, healthcare, all those spending. So I think there is a sense that this needs a bit of a rejig, because RBI can't react to an index where 50% is almost food inflation, because that's not going to, it's not core. And so it's not going to react to RBI rate hikes. So that said, I think let's move to European Union. Vikram, the growth prospects of European Union, not even now, for the last 15 years, actually, right, you go to 2008 and beyond, the European Union has been in a perennial saturation or kind of a slowdown. Look at Germany, look at France, look at UK. These economies and their markets have hardly really, grown outside their phase of maturity when they peaked out in 2008. So I think central banks there, I think where they started at were 3.75%. They can go to even 2%, and the economy would still not show signs of growth. So I think the runway for European Union is very different. The problems that EU faces are also very distinct. So they will have to diverge a little bit from Federal Reserve out here, which is what we see currently, right? Keep in mind that European Union is a monetary union, but a fiscal federation, right? So it's very complex out there.
It certainly is complex. There's no doubt about it, Anurag. Yes, but we have been tracking the European slowdown. Also, what we know is the Chinese manufacturing looking rather weak. There are falling crude oil prices. Markets here in India have proved most resilient, and that's something that we are trying to explain as well at length. Like you said, it's a bit of a conundrum, but we will keep tracking it. Anurag, it's always a pleasure getting your perspective on the markets. Thanks very much for joining us tonight on India Tonight. So like we were...
If you like this video, then like, share and subscribe to ET Now.